The biggest question that nobody asks me is, what happens if I need to get out of this mortgage?
One thing that tends to swing consumer confidence or confidence in real estate investing in general is geopolitical talk. We had the tariff talk in 2025, tariffs going up and down. And we as real estate professionals, we're always looking at how is Sudbury going to be affected?
The biggest thing is preparing and having the right conversation. So sitting down with your spouse or your partner and saying, what are our plans? Are we going to stay here for another 5 years? Do we need to upgrade? Are we looking at changing jobs? Are we going to introduce another kid to our family?
Welcome to the TNT Real Estate Podcast, where we spark conversations that set you up for real estate success. I'm Tyler.
And I'm Tanya, and each week we bring you expert tips on navigating Northern Ontario's real estate market. Whether you're buying, selling, or investing, we've got the tools to help you thrive.
Hi, everyone. Welcome back to the TNT Real Estate Podcast. I'm Tanya, and today I'm joined by a special guest, Andie Martin from Today's Mortgage Choice. Thank you, Andie, for joining us today.
Thank you for having me.
Awesome. So Andie has been a licensed mortgage broker since about 2018, so 8 years. So she's got some really good experience pre-COVID, throughout that whole COVID realm, and now post-COVID, of course. And what I like about Andie's approach is it's no nonsense, no fluff, no panic, just very calm, measured approach to financing real estate and investing. And you've been a guest on our real estate investment seminar, so thank you so much for participating in that with us as well.
Absolutely. Thank you for always having me.
Awesome. So you help homeowners, investors, and people who are looking to become homeowners in terms of mortgage financing. Now, if we sort of take a look back at 2025, I think we can kind of reflect on, we had some different headlines. We were at a point where mortgage rates were quite high, I think, at the beginning of the year. And then they sort of eased into the year as rates came down. From your seat as a mortgage broker, what do you think was the biggest trend that you saw happening last year in 2025?
I think the biggest trend that we had in 2025 was actually quite positive. We kind of stepped away from what is the interest rate question being the forefront of every conversation. Buyers actually started to realize that there's a lot more to the conversation than just their interest rate. Buyers and existing homeowners, especially, those coming up for renewal and stuff. There's been so many headlines about all the panic and all that. But when we take just the interest rate out of the conversation, and, obviously we still focus on that at the end of the day, and that's a large part of my job. There's so many other things, and that was a big part that people really started to realize. I think, through podcasts like this and seminars and everything, people are finally we're starting to get through to them that there's so much more to the mortgage than that. And that's really positive that we started to see that in 2025.
Yeah. Oh, that's fantastic. And we saw a lot of changes in 2025. Certainly, we saw a lot of headlines. It's nice to see that people were less focused on numbers in terms of that rate amount. Do you think people were making decisions based on sort of geopolitical sort of feelings and headlines, or were people sort of making decisions for themselves?
I think you're always going to have a demographic of people who are emotional buyers or emotional shoppers, and who are, going to do their own research and take a poll of their family and friends and everybody else's opinions, which is great to do your research. And, we always want to push education, but we also need to make sure that we're focusing on, and what buyers have started to do is picking apart that information and realizing, okay, in the media, I'm going to get flooded with all this stuff. What is actually applicable to me, and what's actually going to affect me directly? And the next step that we kind of have to look forward to in 2026 is those buyers taking that information and going and verifying it with a local expert, and using the resources that they have locally and the experts in the industry to verify their information based off of their specific situation.
Yeah. We see a lot of people getting sort of wrapped up in the headlines, and certainly in real estate, we tend to hear things more on a national level. And even in Ontario, our real estate news is very GTA focused,
Absolutely.
right? So
Yeah.
there's a tendency to kind of like when you start feeling some symptoms, you start Googling your symptoms and you go to the doctor and you've already fully diagnosed yourself. Do you find that you have some sort of myths that you need to bust in terms of what people think they're Googling and their friends are telling them versus the reality of financing?
Yeah, there's definitely a lot of headlines that they're going to see depending on what type of demographic they are. First-time homebuyers are going to get different stuff online than, a real estate investor is going to get. I find real estate investors spend a lot more time because they are really invested and this is something that they're passionate about, doing that research and looking it up and seeing all of this. So then that becomes their whole feed and it basically just becomes a sounding board for their own ideas where they need to kind of branch out. So like investors, for instance, see a lot of information about like how many doors people have and buy quick and buy now and do all this and now's the right time. When, it's not necessarily always going to be the right time or it's not necessarily always going to be the right property. And at the end of the day, a big thing that I always say is the number of doors doesn't really matter. What matters is what those doors are doing for you. Are they actually profitable or not? Because if you have 10 doors and they make you $1,000 a month, it's probably not worth the headache. If you have 2 doors that are making you $2,500 a month, that's a lot easier and a lot more profitable.
Yeah, that's a really good point. It's so easy to get caught up in this headline and so-and-so is doing this and looking to your neighbor, right? It's like comparison is the thief of joy. So you look at what the neighbor has and they have so many more doors and you feel perhaps that you should be reaching for that type of goal. But you're absolutely correct in saying that it's not necessarily achieving that number of doors. It's what are those doors doing for you?
Yeah, it's quality over quantity.
Yeah, I think that's fantastic. Okay, so let's move a little bit more into 2026. And I think that in real estate and in life in general, I guess if we all had a crystal ball, we would all be super rich and doing fantastic. But nobody has a crystal ball. So I think what a lot of people and what we're hearing certainly in our industry is fixed versus variable. What are people doing now? Are people going fixed? Are they going variable? How do you feel about that conversation?
It is the $1 million question. So every situation is going to be different and the right approach is going to be the right approach for that one person, not necessarily the next. But ultimately right now, in my personal opinion, the variable rate is a really great option. For the right people, obviously, but a variable rate right now, you're looking at about 0.25% difference from the fixed rate. It has gone back. It is now cheaper than the fixed rate. So right out of the gate, these buyers or these homeowners are experiencing savings, and it just provides a lot more flexibility. This kind of goes back to our conversation about not just the interest rate, but there's so many things that can happen in life, and things like penalty calculations are important, convertibility is important, portability, all of these stuff. And generally the fine print of a variable rate mortgage is much friendlier to the actual borrower rather than the bank. Whereas on the fixed rate side, you're locked up a lot more and can come with a lot more complications down the road. So like every piece of financing isn't just what's right for me today, it's also what's right for me long term. So like I said, if you're getting the variable rate savings right out of the gate and have the potential, do I think that variable rates are going to come down significantly? No, not necessarily. But we also have that clause called convertibility built into our variable rate mortgages, meaning at any point you can lock into a fixed rate. So if you get halfway through your term and you notice that the tides are changing and we're going back into a rate increasing cycle, you have the option to, for lack of a better word, I call it the oh shit button. You hit the button and you go, okay, I'm going to stop the bleeding now, right? And lock in. Or on the contrary, what a lot of people are doing right now is taking that variable rate, and my advice is let's wait it out and reevaluate things every 6 months, because there is so much uncertainty going on in the world, so much political distress, all this stuff happening. So let's just continue to reevaluate, and instead of locking in at 4% or mid 4s, let's wait and see for us to get back to a little bit more of a healthy rate on the fixed side of things and ride that out and then do the conversion when it seems more better suited for the borrower.
Yeah, that sounds like a really good option. And I think people got a little bit nervous. Certainly some of us, I had a couple of mortgages that had variable rates and I let it go. I let it go as the rates were going up and up and up. And it did become a little bit scary, but I had to just sort of hold on to that faith that the rates were eventually going to come down. And now certainly they are a little bit more reasonable. But when you're on that upward trajectory, today, how hard is it for that individual to then make that decision that, okay, now is the time? Do you feel like it's a little bit of gambling, or
Yep.
how do you manage that?
So again, it's leaning on your resources. So contacting people that you value their opinion and that you trust and that are in it every day. It's like, if I have a borrower who's a nurse, and my client, is looking for advice, it's the same thing as I couldn't go and hop into the hospital and start caring for patients and administering medication, all this stuff without all the training and the background. It's the same thing. We don't expect homeowners and, the average person to be following the market as intensely as somebody who's in it. So leaning on those resources is going to be super helpful. And really on the fly, continually evaluating your own budget and your own needs. So you're never going to get that perfect timing. It just doesn't happen. It's like trying to time the market in your industry for when's the perfect time to buy, which everybody says it doesn't happen.
Yeah.
Right. So figuring out, what your comfort level is and where your bandwidth is of how much increase you can hold, and also kind of doing your own research and reading through those headlines and saying, where are my beliefs? What do I believe in and what do I think is going to happen? And, where is my risk tolerance going to fall? And then at that point, figuring out, okay, let's look at the cost difference and just continually evaluating what that conversion into a fixed rate would look like.
Yeah. So in the real estate industry, we always say the best time to buy was actually 5 years ago. So I think it's sort of important in that sort of realm that, if you're in that property, it depends if you're an investor, right? If you're an investor, you're looking for a short term, maybe a flip, which I know people don't like that certainly in the financing game. But, if you're going to be in the property for 5 years or more, then, perhaps you can sort of ride that wave of a little bit of uncertainty for the variable rate. But also, I think a lot of people just kind of want to know, what are my payments going to be? And will I be able to afford that in 2 years, 3 years, or 4 years? So do you think that investors are going to be able to have, maybe not investors, I shouldn't say, do you think that people who are looking to refinance or purchase their first home are going to feel confident taking the risk on the variable with these sort of up and down that we saw in the last few years?
Based off of my day-to-day dealings, yes.
Yeah.
I would say right now about 80% of clients are taking a variable rate mortgage. There's definitely people who the variable rate mortgage doesn't suit, for sure. If you're retired and on government pensions and have a very fixed income, no, it's not something that I'm necessarily going to suggest. Or if you're a single mom or single dad with 3 mouths to feed at home, those payment fluctuations can be drastic to you. But a first-time home buyer or an investor, as different as they are, they're also quite similar, where generally they have some leniency in what they can do, right? Especially, a dual income household of first-time home buyers, they're generally pretty young. They generally have quite a bit of growth potential in their income and their earnings. So they can be a really good candidate for that variable rate. Same with an investor who wants that, on the other side, that flexibility and those options of, doing the flips or refinancing once their equity appreciates, all of that. So there's good opportunity out there. And truthfully, a lot of people, although they're nervous, once they get the actual education, that's not just a bold headline on their feed, they're feeling a lot more comfortable and opting for that variable rate in my experience.
That's fantastic. I don't think a lot of people think about that, especially as, a first-time home buyer and being young in your sort of professional career. You do have a lot of upward trajectory in terms of your salary and that sort of job growth. So perhaps there is that room for prepayments and other types of ways to pay down your mortgage. Do you think, are there questions that borrowers should be asking their mortgage broker that maybe they're not sort of looking at?
Yeah, I think truthfully, the biggest question that nobody asks me is, what happens if I need to get out of this mortgage? Statistically, most people will break their mortgage within 2.5 to 3 years of their 5-year term. And nobody anticipates that.
Yeah.
Time and time again, everybody sits in front of me and says, I'm going to stay here for 10, 15 years. And I'm sure you experience it as well and you see it as well. And then they call you 2.5 years later, especially when you start working with them from the time that they're a first-time home buyer. Because just like we talked about, there's so much opportunity for growth. There's also so much opportunity for change. So they could get relocated. It could be a young couple that ends up, getting separated, unfortunately, or they could get married and have kids and need a different situation for their living. There's so much opportunity for change in anybody's life that what happens, that what if, is so important for us to focus on, and nobody does. So it is generally something that I'm going to bring to the conversation each time. And once it's explained and once the stats are kind of shown of when that can actually happen and the amount of possibilities that can really make that happen, that ultimately leads a lot of people to the variable rate, because then they go, okay, yeah, I understand, and there's a good chance that my job will change, or there's a good chance that I will need more space.
Yeah, because if somebody has to move from, certainly if they're approved for $500,000 here in Sudbury, they can get a nice single family home. Job changes and they have to move to a bigger market where it's more expensive. Perhaps they can't even port that mortgage over. So like you said, they would have to then break it and pay quite a large penalty. Have you seen a lot of large penalties in your dealings in this industry?
Especially, so let's take your situation, for example. You're seeing interest rates climb, you're on the variable rate. A lot of people did get nervous and didn't consult a professional and did lock in at 6%, 5.9, all of these different options. And now they're going, oh my goodness, interest rates are so low. Or, I think I can get a pretty good penny for my house. And, I do want something a little bit different. So let's look at switching that up. But what they don't realize is locking into that fixed rate really handcuffed them, because the penalty calculation is directly correlated to how different the interest rates are. So when you lock in on a high interest rate, the lower the interest rates get, the higher your penalty is going to get.
Right.
So you have to tread lightly, even in those upward swings of am I actually going to lock in? Because it only makes it worse when you do need to get out, for sure. So penalties can be tens and tens of thousands of dollars. And, unfortunately, in a market that is uncertain and might not be necessarily appreciating as fast as it did over the last few years, we need to be cautious that, let's say you do go through a separation in 2 years, your house may not be worth $150,000 more than when you bought it. And forking out $40,000 in a penalty when you go to have to sell that house, there just might not be enough money there.
Yeah, they might not have enough money to close.
Yeah.
That's a really good cautionary tale. I think it's very important for people to look at, the reality behind the variable rate and where it's trended historically, rather than just getting sort of fixated on the last couple of years where we had to increase interest rates to sort of stave off inflation.
Exactly.
Okay, so there's some new news in the headlines, or I guess it's been trending for quite a while, news about the mortgage renewals. Yes. So there's this big headlines. We're going to have a ton of mortgage renewals. I know a lot of people who got their mortgages 5 years ago-ish, or maybe 4.5, and they were at rates, some of them even under 2%. Now they're going to be renewing around 4%. The big headline is we're going to have this huge flood of properties coming on the market, a lot of people underwater, yada, yada, yada. What is the truth behind all these renewals?
The truth is it's not as bad as everybody thinks. Okay. Time and time again, I have somebody sit in front of me and they say, yes, I have a little bit of wiggle room, but not that much. And when we actually look at the difference, their payments aren't going up that much. And when they are, there are things that we can do to offset that. So they're not rushing to foreclose, because what the average homeowner is looking at is, okay, if I give up my house, what is my alternative? And we all know the Sudbury rental market, and even all across Canada, rent's pretty expensive. So they're not going to end up that much ahead. So these homeowners are going to do everything in their power to keep their house. So in my opinion, we're not getting that huge flux of, distressed sales, because they're going to do what they can. They're going to re-amortize their mortgage back out. If they're currently sitting at 15 or 20 years, they're going to go out to 25 or 30 like they originally were, so that their payments can decrease and they can live comfortably. And although in the grand scheme of things, I'm sure that's going to cause problems for people later on. Absolutely. And pushing it out is not the best option if you have other options. But at the end of the day, surviving day to day is everybody's number one priority. Life is expensive. Payment size is important, right? So that's something that's happening a lot, is that reamortization. So people aren't seeing that huge influx. And what also people tend to forget is that here in Canada, we introduced the stress test prior to COVID. So the stress test, when you're qualifying for a mortgage, is essentially whatever you're actually going to pay in your interest rate, you had to qualify at either 5.25% or 2% above that. So let's say you were buying a house at 4%, you had to qualify and basically show these banks that you could afford the payment at 6%. So there is that wiggle room here. And although all these calculations don't take into account daycare costs and shopping habits and eating out and all that fun stuff. If we break down all of those non-essentials, you should be able to still afford your payment even at the same amortization. It's just a matter of, are you willing to make the sacrifices in your day-to-day life? But in my opinion, we're not seeing that flux. I don't know. Are you seeing, a lot of distressed sales or anything like that?
No, we've actually seen a couple that have come on the market that I've been surprised by. A few banks having a couple of distressed sales. They're usually lower priced properties, usually in quite a state of disrepair, where perhaps the situation is people have refinanced higher than they've been worth and let them go. But regular people and families who keep their home, well kept, well maintained over the last 5 years, they've gained quite a lot of equity, right? I mean, 5 years ago, you look at where our average sale price was compared to now, there's a huge equity gain for most people.
Absolutely.
And that gives them that buffer room. Like you said, like if they need to refi or stretch the amortization, if they just need those payments to be what they were or very close to, there's got to be room to do that, especially because of the equity gain. But I think back to like when we had our first house and our kids, like our interest rate for our first mortgage was 4.09%. And that was, a bazillion years ago. But I remember those costs creeping up, like, okay, you need a new car and this car's breaking down. And then there's childcare and then this kid needs that. It does get to be more expensive as your life grows and your family grows. But I think if we're looking strictly at that, 4.5 to 5 years ago versus now, people are in a really good position. They've gained a lot of wealth in that home ownership. So there should be some opportunity, some room there for them to, especially here. Perhaps in other markets it's different where the prices were certainly higher, but here we have had a lot of that equity gain. So I think we see a few here and there coming up, but nothing that is going to flood the market. But that's some really good insight. Like I think, it's very important for people to realize that talking to the professional and looking at what their home is worth, what's their equity gain, and what are some options for the refinancing.
Absolutely.
Okay, so speaking of refinancing, what's the smartest thing for people to do leading up to that? So we're hopefully 6 months, 9 months out from someone needing to do this refi or renewal. What are some of the smart moves people can make?
Yeah, absolutely. So the biggest thing is preparing and having the right conversation. So sitting down with your spouse or your partner and saying, what are our plans? Are we going to stay here for another 5 years? Do we need to upgrade? Are we looking at changing jobs? Are we going to introduce another kid to our family? All of these conversations are things that you don't necessarily think of when your mortgage is coming up for renewal. You're thinking payments, you're thinking interest rate, right? But all of those things tend to lean in towards our conversation of what actual options should we consider, and even breaking those conversations down further and really looking at what can we afford and what do we need? Do we need to do renovations on the house? Do we need a new car in the future? Is there going to be a maternity leave coming up? Things like that, so that is payment the most important thing? Is us paying off the mortgage the most important thing? Do we need the flexibility to be able to move all of that? And, a big problem that I have is a lot of people come in and, we're looking at payments for the renewal and I'm saying, well, what can you afford? And a lot of them ultimately don't know because money comes in, money comes out, everything's so automated. Nobody knows what's left over at the end of the month or what their bills are actually costing them. So I often suggest, and a piece of advice that I give is to actually print out those bank statements and put, pen to paper, take a few different colored highlighters and categorize things. So, maybe you go through and highlight all of your housing costs in pink, and then your vehicle expenses could be yellow. And then you can look at the end of the day and say, okay, all of the income that I've brought in versus what are these necessary expenses that I have? How much should I have left over at the end of the month? Chances are it's not going to be exactly what you actually have left over because we all have that fun spending. But it allows us to see, is there fat that can be trimmed or are we already kind of maxed out? And is there wiggle room and how much that wiggle room is so that we can prioritize and say, okay, you know what? We need a little bit of break on the payment, but not necessarily stretching our amortization out back to the maximum of 30 years, right? So having that fluctuation there and knowing what our bandwidth is going to be super helpful for preparing, and also looking at the full financial picture, not just the mortgage. What else do you have going on? A big trend right now is not actually just doing a renewal, it is refinancing and consolidating the high rate debt. And actually, most people are coming out cash flow positive and better off than they were on their original mortgage because all of these credit cards and lines of credits that Canadians have racked up, and there's no shame, but almost everybody has them. Everybody's carrying a lot of debt right now. Nationally, we have massive debt rates, and that debt is, those minimum payments are crushing everybody, right? So if you can wrap that all up into one, not only is it going to cost you less in interest, generally your monthly cash flow is going to be better, and also it's just easier to manage, less payments.
That is so important and such really good advice, because I think so many of us, again, we're just so fixated on the rate. What's the best rate I'm going to get? But you take a real holistic approach to it.
Absolutely, yeah.
Like, what does our family need? What does our household need? What are my plans for the future? And like you said, I think that's a very good point. A lot of people do have a lot of, maybe a little bit of debt here and there, maybe a $10,000 line of credit because you had some additional payments that needed to be made on a car or something like that, an emergency spend. Maybe you wanted to take a nice trip, so you put it on the line of credit. But that's a really great approach, is to look holistically at your budget and at your actual spending and what you need moving forward. Because like you said, people's needs change from year to year. So it's a good opportunity even for people to reevaluate and to refinance.
And to plan ahead, right? What you might need now, and that's why having those conversations ahead of time is good, because you can also look and say, in the next 2 to 3 years, am I going to need a new furnace? Do the windows need to be upgraded? Because if you decide to not have that conversation and then wait for 2 to 3 years, now you're going to have to re-break your mortgage, pay the penalties, pay the lawyer's fees, all of that, and just incur extra costs that you don't need.
Yeah.
Right? So if we plan ahead, we can set all of that up and have the mortgage well suited for that timeline.
Yeah, well, that's fantastic. Okay, so let's shift focus a little bit in terms of investors. We found anecdotally here in Sudbury for real estate, investors really weren't feeling super keen, and they weren't back in the droves that they were certainly in years prior. We're predicting that 2026 is going to be different. Investors are going to have increased confidence, and they're going to come back to the Sudbury market. So if you were looking at an investor profile, let's say, what would be like a good mortgage file for an investor in 2026 in terms of like income, credit, and assets, that type of thing? What do you look for?
Yeah, so unfortunately right now, financing for investors is, in my opinion, harder than it's ever been.
Oh, wow.
The banks are looking at it the same way any investor is and saying there's a lot of uncertainty out there. And a lot of these investors got these real estate portfolios during COVID when interest rates were 2% and they could afford to leverage them to full 80%, some of them even higher than that with vendor takebacks and different stuff. And then things changed, and a lot of those investors were on variable rates, and now their payments are significantly higher, their cash flow is drastically reduced. So the bank is basically footing the bill on all of that and sitting there going, let's cross our fingers and hope that everything works out. So they're going to do their extra due diligence now to make sure that things are going to play out okay. So more so now than ever, personal income is a big thing. Making sure that, you don't get 2 or 3 properties and then go and leave your job to pursue your real estate passion. At some point, yes, that's fantastic, but it is so hard to get approved right now for investment properties that having a good base salary to fall back on gives the bank so much comfort. What if something happened like COVID where our prices started to go up and then all of a sudden the government changes the rules and now we can't evict anybody? Your tenant stops paying and you're on the hook for that bill. If you have no backup job, that's going to be extremely difficult, right? Same with backup savings. Making sure that you are, having some money sitting in an account. We call it a fallback position. So it's the income, the credit, and the savings, making sure that if something goes wrong, you have the means to still survive, right? So like I said, making sure that you put money aside, even if you are refinancing and you're using that money to go towards another investment, take out a little bit extra and put it in just a little nest egg for yourself. Stuff like that can prove extremely helpful, but it is tough. It is absolutely possible out there. It's just not giving out money like it may have seemed like they were in COVID.
Yeah. I think sort of the social media behind it all, in years past has been like zero money down, get as many doors as you can, and all that sort of hype for investors. But really, it's nice to see from an investment standpoint and from a financing standpoint that the banks are still protecting their assets. They're still being very cautious and they're not over lending to people who are maybe not so qualified. And I think that's maybe something that we are really lucky for in Canada, to have sort of CMHC backed loans and to have that stress test over the last several years. That is maybe, it's tough because it's kept some people out of home ownership, certainly, but it's made it so that those who do qualify can actually weather those storms, right?
Exactly.
Like the tenants not paying rent or the rates going up, etc. So I think, hopefully in Canada, we're a little bit protected from that sort of crash and burn.
Yeah.
Okay, so one thing that tends to swing consumer confidence or confidence in real estate investing in general, is geopolitical talk. We had the tariff talk in 2025, tariffs going up and down. And we as real estate professionals, we're always looking at like, how is Sudbury going to be affected by, let's say, the 25% tariffs on various materials. Now, things are changing. Even every day, there's like 51st state. There's a map with Canada having a U.S. flag on it. All sorts of inflammatory type headlines and rhetoric going around. When these big economic headlines hit, how should home buyers, potential home buyers or investors move into the market? Should they like pivot? Should they pause? How should they move forward?
I would say first you need to pause to plan and do your proper due diligence and then move forward. There's always going to be stuff going on in the world at all times, right? Like you said, in 2025, it was tariffs. In 2026, there's Venezuela, and there's all of these other stuff going on, right? So it's just a matter of figuring out, what your situation can allow and where your comfort is, because again, there's never going to be a perfect time. And I do think going into 2026, we're at a very similar time as what we were going into 2025. A lot of uncertainty, right? There's so much going on. And it kind of ebbs and flows. But the people who bought in the start of 2025 really aren't in that bad of a position, right? We didn't see a major interest rate hike. We didn't see all of this, crash in our market, especially here in Sudbury, where we are a little bit more resistant to the massive swings.
Yeah, absolutely. And we didn't see prices decrease either in terms of real estate. We saw prices increase maybe 4 to 5% year over year from the beginning of 2025 to the end. So like you said, people were ahead. So maybe the advice is just to not listen to the noise, just kind of do what's right for you, because year over year, you'll be ahead as long as you make your decisions cautiously.
Exactly.
And what's right for you. So what's the equivalent of don't doom scroll the market? in mortgage terms?
I would say it's to stop reacting to the headlines and to start running your own numbers. You see a TikTok that comes across and gives you all this information. It might not even be for our country half the time, right? And we get all of this doom information that can cause so much panic and so much concern. When all of these things change constantly, the economy is constantly changing, our politicians are constantly changing. There's so much change going on there, but what we need to focus on is what doesn't change. Our income doesn't change. Our timelines don't change. Our goals don't change either. Mm-hmm. So building a mortgage that will withstand the test of time is ultimately what we need to look at, instead of that doom scrolling the market and reacting to the headlines.
Yeah, that's fantastic advice. Okay, so let's do a little lightning round of super fast advice by Andie. So what would be the number one rate myth that you would want to kill forever?
Being loyal to your bank doesn't mean that you're going to get a better interest rate.
Oh, one sentence of advice for first-time homebuyers in 2026.
Start before you feel you're ready.
Oh, wow. Okay, I like that. One sentence of advice for renewals in 2026.
Your renewal is not a crisis if you start planning early.
Oh, I love that. What about investors? One sentence for investors in 2026.
I like this one. I think 2026 is all about trimming the fat, protecting your cash, and doubling down on investing in profitability.
Oh my God, that's amazing. I love it. 1 minute advice, one sentence advice from Andie. That's been fantastic advice. Thank you, Andie, so much for joining us. I think the overall feeling of this podcast has been that, people who win in the market aren't chasing hype. They're not listening to the headlines. They're making calm, informed decisions overall. And so the best way to get educated is to contact your local mortgage broker, contact Andie Martin. We're going to have her information in our show notes here, and you can get your personalized advice and strategic meeting for 2026 and moving forward. So thank you so much, Andie, for joining me today.
I really appreciate you taking the time and inviting me on. It's been great chatting with you, Tanya.